Welcome to the WealthWise Show, where financial success meets informed decisions. I'm your host, the Wise Investor, and I'm here to guide you through the fascinating world of finance and help you to make wise choices. Join us as we unravel the secrets of smart investing, effective money management strategies, and the different realms of financial education. Remember, the information provided on this podcast is for informational purposes only and educational purposes only. Always consult a financial professional before making any major financial decisions. Now let's start the show. Welcome guys, welcome to another episode of the WealthWise Show. I appreciate you guys listening to me again. I'm doing things differently this time around. First, let me get some housekeeping out of the way. All my content, my words, are for educational purposes only. This podcast, this episode, all the other episodes are for educational purposes only. It's not meant to be taken as personal finance advice because I don't give personal advice over the internet. If you hear anything, like, if I mention a company, or like today we're talking about the NASDAQ. If I mention some of the companies in the NASDAQ, I'm not endorsing those companies. If I mention a product or a service or a website, I'm not endorsed by that website unless I state otherwise. Educational purposes only, guys. Do your own research. Speak with your fiduciaries and your financial advisors. With that being said, today I want to talk about something interesting. First, I wanted to mention that, I'm doing, longer episodes and kind of cutting them up into different parts. That's first. So this is actually going to be another 2, maybe 3-part episode, probably 2. And then beginning of next year, 2024, I decided I'm going to go ahead and do video. So it's not going to be a traditional podcast studio because I don't have a podcast studio. I have my room. I'm not going to do it in my room. I want to do it with something more natural lighting and things like that. So I'm probably going to do it from my car, back of my car. And that way, if I have things I want to put up on the screen, I can do that in post. And, you guys can actually, for those of you who want video, who, prefer video versus audio, I'm trying to cater to the audio crowd and the video crowd. And of course, since I'm a new podcaster and new at this, so if it doesn't work out, hey, I tried and find something else to work on. So, we're going to see if it works. So starting January, I think the next episode in January will be January 5th. Starting then, I'm going to move a lot of content to video. So, go subscribe to my YouTube channel, The WealthWise Show, our Instagram, The WealthWise Show, and, that way you can get latest updates. Now, on the Instagram tip, I'm not 100%, I'm not 100% active on there like I should be because I'm doing everything. But I'm going to do better starting next year. So this episode, I want to talk about the NASDAQ. So last couple episodes, I was talking about the S&P 500 and why it was important and what the history was and all that good stuff. And the reason why I'm explaining the indexes, at least the 3 big indexes, the S&P, the NASDAQ, and the Dow, is mainly because, these indexes, I'm not gonna lie, probably the best indexes in the world. I think they're some of the best indexes in the world. And like I said, these are my personal opinions. So if you don't feel that way, that's fine. So with that being said, the NASDAQ is one of the best tech indexes, there is. And the NASDAQ is actually, unlike the S&P, the NASDAQ has, the S&P 500, I should say. The NASDAQ has a crap ton of companies on its index. I think. Oh, actually, I'm sorry. I had a. You gotta excuse me. I have ADD or ADHD, whatever it's called. I don't know. I'm not diagnosed, but I do know. I just thought of something and I was gonna say it, but it has nothing to do with what I'm talking about. So the NASDAQ, has about 5,000 companies listed and traded on its exchange. It's an actual. The NASDAQ is a marketplace. So unlike the S&P 500, where it's doesn't have its own exchange, like the S&P 500 is, like I said before, Standard & Poor's, and Standard & Poor's is a credit rating company. It rates give credit ratings to other companies, other listed companies, and the NASDAQ is an index that has companies listed on in the NASDAQ, but also it's an stock exchange. And it's a stock exchange that has its headquarters in New York. And the reason why that is important, because to get on the NASDAQ or to get on the New York Stock Exchange, you have to go through what's called underwriting, and in the underwriting, a lot is revealed, before you IPO. And for those who don't know what IPO is, it's an initial public offering. Meaning, it's an offering for the public, the first offering for the public. And you can't do that unless you're on an exchange, because how else are you going to buy it? Unless you buy it privately, but then it's not a public offering, it's a private offering. So I'm saying all that to say pretty much that, when you're have a company and it's on the NASDAQ, the NASDAQ is privy to a lot of that information. Just like the S&P 500 is privy to a lot of a company's information, because, they dive deep into whether or not this company is going to have a AAA credit rating or a BBB credit rating or etc. The NASDAQ has, to get on the exchange, there's companies and other brokers and banks and all that stuff that do the underwriting to make sure that the company says what it actually, whatever it says is true. So the NASDAQ, have their own exchange, but they also have their own index. So the NASDAQ was opened up in the 70s, 1971. February 8th, 1971. And it was the world's first automatic stock exchange. Back in, I would say, like the early 1900s, when the stocks were like, it was a bunch of men in a room with pieces of paper, and everything was written down, and when you actually went to the exchange, it was a madhouse at times. So the NASDAQ, first of all, the NASDAQ is very tech heavy. So it makes sense for it, being a newer stock exchange and a newer index, which is, in the 70s and 80s and 90s, where the tech, I don't want to say the tech boom, but technology started to get more advanced. The technology started getting more advanced in those years. So, like I said, there's more than 5,000 companies listed and traded on the NASDAQ exchange. And like I said before, majority of these companies are technology-based companies. And then, some of those companies are going to be Apple and Microsoft. But, like I said, when you are on the exchange, it's literally just, the difference between an index and exchange, first of all, is the index is, it's what the name is. The index is the index of a certain amount of companies. An exchange is what it sounds like. You're exchanging shares and all that stuff. So I know I'm gonna have to separate those two throughout this series. Just be patient with me. So a lot of times the NASDAQ, their index, have a little more than 2,500 stocks listed on the NASDAQ exchange, the composite. And like I said, most of them are Apple. I should say most of them are. Most of them are technology-based companies like Apple, Facebook, Tesla, and such and so on. And the thing about the NASDAQ that I really appreciate is because it's unlike the S&P 500, even though there's, a bunch of different companies in the NASDAQ, the S&P 500 have the best companies from different sectors. Now, the NASDAQ, even though they might have different companies that do different things, but majority of them are going to be technology-based companies. So you're not going to have that, I would say, diversity. You'll have diversity, but not as diverse as the S&P 500. And so understand, the NASDAQ is technology-based, and technology is a typical sector of growth. It's a growth sector. So basically, if you're looking at forward yields, PE ratios, and things like that, I'm pretty sure I explained what PE ratios and all that stuff back in other episodes. I'm going to go back and check, and if I haven't, I will explain it in another episode. But, when you're looking at growth companies, like technology companies, typically you are buying them based off the value that they're going to produce at a later date. So that's, you're buying them for that growth because they're going to grow. And because of that, growth companies are very volatile because they haven't really proven that, that revenue that is projected is not happening now. So you're really, I don't want to say taking you're basically, it's a little bit more riskier, I would say, than maybe a value company that, hey, this is how much I have now. This is how much I'm going to make next week. This is how much I'm going to make next year. And, that because of the track record. A lot of growth companies, especially newer companies that IPO, they have to pretty much prove themselves, but people throw tons of money in them because they hope that they grow. So basically, I'm saying all to say is the NASDAQ, in particular the NASDAQ 100, which is the index that has, 100 of the largest U.S. and international non-financial companies, typically large cap growth companies. So the thing about the NASDAQ 100 is it may be a little bit more volatile than, say, the Dow or the S&P 500. And I'm saying all to say is when you're looking, sorry, I almost coughed. When you're looking into investing in index like the S&P, or not the S&P 500, when you're looking into investing in an index like the NASDAQ 100, that's one of the considerations that you're going to have. Like, hey, I know it's mostly technology based, and I know that typically technology, it has great room for yields, but it also has great room for downside drawdown. So next, I want to talk about, we talked about basically the history. Like I said, it was opened up in 1971. 5,000 companies trade on it, domestic, international, and all that stuff. It's the world's first automatic exchange, so that's the history. And then one of their popular indexes, one of my favorite indexes. Okay, I know I said really my two favorite indexes are going to be the S&P 500 and the NASDAQ 100, or the S&P 500. Oh yeah, I said it right. The S&P 500 and the NASDAQ 100. But yes, the reason why I really like, the Dow is great too. Don't get me wrong. And I'm going to talk about the Dow later on. But the reason why I in particular like the NASDAQ 100 is mainly because, like I said, it's technology based, and I'm younger. So because I'm younger, I love technology. I was born in '93. And so, a couple of years before the tech burst, I went through 08, 09 as a kid. And I've seen how technology has really grown in the last 23 years. Think about it. In 1999, did we think we were going to have AI? AI that can record and change your and sound like your voice, or write whole essays, write whole websites for you? Do we think that at our fingertips that anyone can just have access to a high level AI system? No. In 99 we were thinking about all sorts of other things. So I really like the S&P 500 because I feel like a lot of time technology is a great factor for did I say the S&P 500? The NASDAQ 100. If I didn't say that, then ignore that. Because it innovation, that's the word I'm looking for. So the NASDAQ 100, is a index that the NASDAQ had put together, and is listed exclusively on the NASDAQ exchange. Makes sense. Is their exchange, their product, and it has a tons of different assets in it. From common stocks and depository receipts, stuff like that. I don't want to get too much into it because I know some of you might not understand it, and I feel like I'm going to have to explain it. So in order for me to avoid having a bunch of different topics in this episode, just understand that the NASDAQ 100 has more than just, a few things. But it's, unlike the S&P 500, it's not so diverse. It is diverse, but it's not so diverse like the S&P 500. The composite, is 100 companies. So the S&P is 500 companies. So you're literally taking a very fraction of the companies that S&P has and put it in an index of 100. So you can see we really can't have too many because I don't think it has financial services in the the NASDAQ 100 don't have financial services. I don't believe so. Don't quote me on that. Double check. Do your research, but I'm pretty sure it don't. But there's 8 total sectors in the NASDAQ, and whereas there's 11 in the S&P. So you can see how it's not fully diverse. But that doesn't mean it's not a great index. Because like I said, it is heavily technology based, and technology drives innovation. Innovation drives the economy, and so forth. So it is a needed asset. And so right now, I think it's technology, consumer discretionary, industrials, staples, utilities, materials, energy, and healthcare. Yeah. I think those are the sectors. Let me make sure. Yeah, I think that's about 8. So those are the sectors. Technology, basically what I just said. And technology is being one of, I think technology and consumer discretion is the biggest percentage-wise of the NASDAQ 100. The top companies are going to be, of course, your Apple and Microsoft, of course. Your Amazons, your Nvidias, your Facebooks, your Teslas, your Google, Costco, Broadcom, things like that. Those companies are probably some of the most important companies in the country, I would say. And as you can see, they're mostly technology companies. And some people don't like to say Tesla is a technology company, it's a car company, but their technology and this is not a Tesla thing. I just know they have a lot of technology that they are innovating that a lot of car companies are not. So, So anywho, so basically, those are some of the top companies of the NASDAQ, and typically people, when they use a NASDAQ in their portfolio, they're using it as the growth portion of the portfolio, because typically a diverse portfolio is going to have a mixture of value growth and cash equivalents, or in bonds or things like that. Fully diverse portfolio. And the reason why that's important, because I know a lot of people might feel like, well, why not just throw everything into growth? Well, now you're dealing, can you really handle the drawdowns that growth can potentially take? You know, even though you might feel like you can, but when you are actually, you know, I think it's a good analogy. I was at my firm sent us to Minnesota, and one of the it was advisory training, and one of the instructors were saying, like, you know, when you talk to your clients about risk, you know, they might think they can handle a certain amount of risk until it happens. And the analogy he was using was basically like, you know, think about like if you're on a shoreline and you're about to go on a boat with your client, and you guys are waiting for the boat to come in, and you're on the shore and you're looking out in the ocean, and you say, hey, now we're about to get out of here, get on this sea, can you handle this? And looking from the shoreline, it's like, oh yeah, I got that. You don't see the waves, like, you know, it looks calm, it looks peaceful, you know, you hear the seagulls chirping and all that stuff. But then when you actually get on the boat and you venture out to sea to where you can't see the shoreline no more, and now you're in there, you know, with the giant 10-foot, 11-foot waves, you know, the boat's bobbing and weaving. Now your client's seasick, and I want to go. I want to get off this thing. They couldn't handle it. So basically, if you're investing 100% into, you know, a growth index like the NASDAQ, you know, can you handle the drawdowns? You know, if you're invested 90%, 80%, if the large portion of your portfolio consists of growth companies and growth indexes, can you handle the drawdown? And you might say yes until you see your value is down 30%, you know, or it's cut in half because, you know, something happened and so forth. So yes, the ups are great, but, you know, the downs can be just as great. So that's where, you know, if you're going to have a diverse portfolio, you know, typically you do want some growth because you want it to grow. But if you are, let's say you're someone who's young and is building equity, then I can understand why you want growth, because you're young, you're trying to grow, you're trying to build this, you know, etc. But if you are, you know, someone who is actually, you know, got your career, you know, you got some savings, your debt is low, virtually none, you know, you got some excess cash that you want to start investing with, you know, growth might not be your thing, but cash preservation is. And one of the things is, if you're looking to preserve your capital and let it create some interest for you or some yield, then having a diversified portfolio is important, because now your downside is protected by certain things in your portfolio. You see what I'm saying? So if you, basically I'm saying all to say the NASDAQ is important, but, you know, understand the risk involved in the NASDAQ, and not just the NASDAQ, but everything. Understand the risk. And that is why it's important to have a fiduciary financial advisor, to, you know, bounce ideas off of, to kind of help them, because their job is, you know, controlling your risk. You know, if you say, hey, this is too risky for me, their job is to put you in something that you can handle, the right amount of risk. So basically, yeah, I know, I think, hopefully that wasn't a rant. Hopefully that was enlightening. I talked about the NASDAQ, which it's used for, is, you know, predominantly for large cap companies. Now you can invest in the NASDAQ, but you can't invest directly into the NASDAQ, I should say. Like, you can't invest directly into the NASDAQ, like the S&P. You know, typically you'll want to use, ETFs and mutual funds, you know, things like that. You know, you can invest in the Qs, as they call them, Investco's QQQ. That is a NASDAQ driven, index ETF. So, you know, if you want to invest in the NASDAQ or the S&P 500, you know, you have to use other means. You can't go and buy shares of the index. So I think that's, we're on 23. All right, let's talk about the differences of the NASDAQ and the S&P 500. I talked about it a little bit, but they, you know, they're kind of similar, as the NASDAQ and the S&P, you know, they are stock market indexes that track the performance of large companies, and both of them, indicate the market's performance. So when you are looking at the S&P and the NASDAQ, you're looking totally at the market essentially. If the NASDAQ and the S&P is down, the Dow too, but people really look at the S&P and the NASDAQ, really. And so when you're looking at those two indexes, you might basically see the health of the stock market essentially. And even though they're similar, there are, some pretty big differences, besides, the NASDAQ having 100 and the S&P having 500, the S&P 500 only has U.S. companies. So it doesn't have foreign companies. But the NASDAQ includes foreign companies. So that's another thing you have to think about when you're investing in the NASDAQ versus the S&P is, are you comfortable with investing in foreign companies? And there's nothing wrong with, I can't say that. If you feel like there's something wrong with investing in foreign companies, that's but me personally, I feel like, if the company is great, they might be in a different country, different set of rules. But if you do your research, do your due diligence, and have your fiduciary look over it, and it makes sense, why not? Also, the S&P 500 has, majority of all the sectors. Like I said, it has 11 sectors, while the NASDAQ only has 8. And the NASDAQ, excludes companies from the financial sector. So the financial sector is not in the NASDAQ. And, the NASDAQ is a exchange also. The NASDAQ 100 is the index, but the NASDAQ is its own exchange, while the S&P, it trades on all U.S. exchanges. So those companies trade on all U.S. exchanges, and, it's not like, its own thing, its own exchanges to say. So you can, purchase the NASDAQ and the S&P 500 ETFs, their index ETFs, and you can't directly, invest in indexes. But, those are the differences essentially. It all depends on, your personal preference, which, everyone has their own. Everyone's entitled to their own. And so pretty much the NASDAQ as a review, because this is the end of the episode. And I'm pretty sure I'm going to turn it into a 2-part episode. I don't know where I'm going to stop at. So I know the cut might be a little different because I might just stop abruptly. But understand, well, this is going to be the second half. So yeah, you already heard the abruptly, the stop that was abruptly stopped. So I'm not gonna cut it and have like, hey, this is episode what you call it. I'm just gonna cut it in half and do that. It kind of helps me out. It's towards the end of the year, guys. I'm trying to do a bunch of stuff at one time, so this just kind of helps me out a little bit. And hopefully it makes sense. And I think we got one more episode of the year. And like I said, next year I'll be doing videos, probably from my car. And because until I develop a podcast studio, so we'll see. And yeah, that's about it. I appreciate you guys listening to me this year. It's been a journey, a lot of learning and life lessons. Hopefully I imparted some wisdom. Hopefully I help some folks out to understand a little bit more about finances. That way they can make some informed, wise decisions for themselves. And hopefully, I continue this journey and we continue to grow. For my day ones, I appreciate it. If you're just joining, this is your first episode, I appreciate you as well. Don't forget to subscribe to my YouTube channel, because that's where the video portion of the podcast is going to be. And if you have any questions, just let me know. Like, comment, subscribe. I appreciate it all. And that is it. So until next time, guys, stay WealthWise. Investment advisory and financial planning services offered through Simplicity Wealth and SEC registered investment advisor. Sub-advisory services are provided by Simplicity Solutions, LLC, a registered investment advisor. Any insurance, consulting, and education services offered through the WealthWise Show. The WealthWise Show is not affiliated with Simplicity Wealth and Simplicity Solutions.